This is Danica Weepa, Marketing Manager at RKLE Solutions. Thanks for joining us today. Today's session will be a CPE session for applying the new lease guidance for ASC 842. Before we start today's call, I'd like to share a few housekeeping items. Second slide, please. This webinar is being recorded. We will be providing a link to the recording and presentation within 24 to 48 hours. All lines will be muted and will remain muted during the webinar. Questions can be submitted using the Q&A button at the bottom of your screen. This webinar is eligible for 1 hour of CPE in the field of computer software and applications and will be issued to participants. To be eligible for the CPE, you must be connected to the session, both audio and presentation for its entirety. Additionally, participants must answer the 3 question elements of engagement through the poll presentation feature. The poll questions will be open for 2 minutes during the presentation. If you're viewing through a web browser, ensure that you have pop-ups enabled. If the question does not show, just click the presentation screen and the question should display. If you are using multiple monitors, a poll may appear on your second screen. You can also find them on our website. Also, if you need CPE, please listen. CPE credits email will be coming from a Pollara email address. This will not be coming from an RKL email address. So please be sure to check your junk, your spam, your IT trash folder, because we are finding a lot of these emails are getting held hostage. But if you're having any issues, you can follow up with me and I will help you resolve them, getting the correct CPE email. Today, Jason Parker is our presenter. Jason is the Accounting Solutions Manager at Lease Query. Jason began his career with the big boys at KPMG in their audit practice. He served both public and private clients in a wide variety of industries. Jason is a licensed CPA in the state of Georgia and earned a dual master's and bachelor's degree in accounting at the University of Georgia. We are very excited for Jason to share some guidance on how to apply the new lease standards of ASC 842. This has proved to be a very popular topic, and I'm sure you all will gain some valuable insight for Jason's presentation. Go ahead, Jason.
Awesome. Thank you, Danica, for the excellent introduction. So we can go ahead and get started. So yeah, as Danica mentioned, my name is Jason Parker. I am an accounting solutions manager here at Lease Query, and we are presenting as a partner with RKL. So we did just want to point out that for those of you joining us who are customers of RKL, us and RKL have become partners, and we are their provider for lease accounting compliance under 842. So Lease Query as an organization, we provide technology to assist with compliance for the new lease accounting standards. So with the 842 deadline upcoming for 2022, of course, as Danica mentions, this is a hot topic right now as organizations are looking to begin the process of adopting this new standard right now. So without further ado, we can talk through what our agenda is going to look like today. So the first topic we are going to cover, and really from a holistic perspective, our presentation today will be walking through an example where we take a lease agreement and we actually account for that lease agreement throughout its entirety through the adoption of the 842 standard and ongoing. So when we begin, we're going to talk about key dates as well as the term of the given lease. So with that, we will identify how to determine what the accounting term is. And in addition to that, we will talk through what additional dates that you might recognize as you look through a contract. And that will lead us into the components of the contract, specifically the financial ramifications. We will talk through what payments actually constitute a lease-related payment and what payments are more so considered non-lease components of the contract, and what aspects of the contract may not be relevant in the discussion with leases at all. So we'll talk through all of those examples. We will then identify what borrowing rate to use when you're actually capitalizing these leases on your balance sheet. Because for those of you unfamiliar with the 842 requirements, the big change with lease accounting is that you will have to capitalize a liability and asset for all of your operating leases, whereas previously you were simply recognizing an income statement impact, right? So once we calculate the liability and asset with that borrowing rate, we will then walk through the actual booking of initial and subsequent journal entries. So we'll talk through what that first journal entry will look like, and then we'll show you what journal entries might look like on the go forward. So that's going to be the gist of what we talk about here today. And of course, as Danica mentioned, if you guys have questions throughout the presentation, please feel free to use the Q&A box, and we will attempt to get to those at the end of the presentation today. And we'll go ahead and launch that first polling question before we begin talking key dates.
Did the poll get launched? Jason, can you see the poll?
I don't see it. I'm not sure if I, as a panelist, would be able to see the poll, though. That's the only thing.
Yeah, I'm having, oh, failed to launch it. Let's try it again. Uh-oh. My computer was having troubles earlier. Please hold on. Jason, if you go down to the polling section, can you hit, do you see polling? Can you hit launch poll? Oh, there we go. It launched. Cool. Everybody has 2 minutes to answer this question if you need CPE. And Jason, you can move on.
Awesome. All right. So key dates. So as we mentioned, what we're going to do is introduce you to a contract, and we're going to talk through some of the dates that you might see within a contract here. So just for a little bit of background, we are going to pretend that this organization is a private company with a standard calendar fiscal year. So fiscal year ending December 31st, which means that their transition date to the 842 lease accounting requirements will be January 1 of 2022. So we'll keep that in mind as we go through. Now, in terms of a background, there's going to be 3 dates that we talk through on this background slide. So keep that in mind. The tenant in this example is entering into an office lease agreement on October 24th, 2020. So that date right there is going to be the date that the tenant actually signs the contract. So we'll consider that the execution date. The lease agreement will stipulate that commencing on January 1, 2022, the tenant will lease all of the office space in the building, 3rd, 4th, and 5th floors. That has to be constructed and owned by the landlords. We've got January 1, 2022. We will consider that the contractual commencement date. Now at the bottom, we'll add some additional detail that the construction on the building was actually completed ahead of schedule. So the landlord decides to grant the tenant early access into the building on November 1 of 2021. So we will reference that date as the early access date. So what we are trying to do here when referencing all of these dates is determine which one of these actually qualifies as the accounting commencement date. And what we mean by the accounting commencement date is when do we actually begin calculating our amortization schedules? And you may, as an attendee of this broadcast, already potentially know the answer, because why would we ask the question if the answer was super, super obvious? But again, when we think about the accrual basis of accounting, the purpose is to recognize the transactions at play over the term that they actually occur, right? So if we are trying to recognize an expense over the term in which this asset, the building, is used by the tenant, we need to consider the period that this asset is actually used. So what we're going to do here is give a little bit of a multiple choice quiz here. So we will have all 3 of those dates we talked about: the execution date, the early access date, and the contractual lease commencement date. What is the true accounting lease commencement date here? And again, as I've alluded to, the answer is going to be B. that early access date. So you, as a lessee within a lease transaction, you will need to determine not only what day the contract says the lease begins, but the delivery date for equipment, the actual entrance date for real estate. When do you actually begin using the lease asset itself? Because again, that is what we are trying to measure with our amortization schedule, is the period of use. So November 1, 2021, this is going to be the date that our lease starts as we begin accounting for that lease. Now, for those of you who are on the ball with us today, you will also notice that that date does come before our transition date to ASC 842. So we will actually begin by accounting for this lease for 2 months before we actually transition the lease to 842. And we will talk about how that might impact our initial calculations under 842 a little bit later on in the presentation. Now, some further background to help us identify what the actual term of the lease will be in full. So the contractual term is going to be 108 months. That is going to begin on the contractual lease commencement date. So as a reminder, that's going to be that January 1 of 2022 date. Moving to the bottom here, you will notice that the tenant will have the option to extend the lease term for 10 years for a price equal to the greater of, and I emphasize the term greater, as that is the piece of this you'll want to remember as we move into the next slide. But the renewal pricing will be the greater of the fair market value in that period, or $13 per square feet. So once again, the greater of fair market value, or $13 per square feet. So we have developed a timeline here, and what we are going to do is try to identify which blocks of this timeline are we actually including in the initial amortization schedule, which would be the initial lease term, right? So starting on the left, we've already done this part, right? We know that that November 1, 2021 early access date, we do want to include that in our accounting term because, of course, we are using the asset in its intended capacity for that period. Even though the piece of paper, which is our contract, tells us that the lease begins later on, again, we want to measure expense from an accrual standpoint over the period of use. So we're going to include that period in the initial term. Now, the contractual commencement date for 108 months, of course, we're going to include that as well because we are expecting to utilize and contractually allowed to utilize the asset for those entire 108 months there. Now, the big question here that we need to ask is, will we include the renewal within our initial lease term? Now, under 840 and 842, there are organizations that maybe don't realize this, but under both standards, you do technically need to evaluate whether you are reasonably certain to exercise any option that exists within your contract. Under 840, the terminology is reasonably assured. As you transition to 842, they will change the terminology and mention reasonable certainty, but the basis of conclusion for 842 authored by the FASB would signify that both reasonably assured and reasonably certain are essentially the same thing. So for some reason, they just decided to change the terminology itself, but you shouldn't evaluate any differently. So the idea here is we need to determine whether we are reasonably certain to exercise that renewal option that exists within the contract. And there's a few ways that you can go about evaluating reasonable certainty. One of them, of course, is price, and that's what we're going to focus on today. A couple other options, though, when you think about moving costs, right? If you're renting real estate, maybe it isn't the renewal price itself, but the cost to actually pick up and move to a new location may be so large that there is just no reason why you would actually move locations, right? So that's one thing to consider there. There are a handful of additional things to consider, but thinking about price, right? When we discussed what the price for that renewal was, we talked about the greater of fair market value and $13 per square feet. So because there is no ceiling on what we will pay, how can we be so certain that we are going to exercise this renewal option, especially there's no way for us to estimate what fair market value might be 10 years from now, right? Just an impossible thing to do. So it can be that simple, right? Where we just decide, hey, because fair market value is unidentifiable, we are going to use our professional judgment to say that, yeah, you know what? We are just not certain whether we're going to exercise this renewal option. So because of that, we are not going to include this in the initial term here. Now, of course, it will be an option within our contract that we can choose to execute at any time and modify our agreement. But until we do that, our lease term will consist of 110 months. And that will incorporate the 108 months in the contract itself. And it will also incorporate those 2 additional months from the early access date until January 1 of 2022. So that's going to be our term, 110 months. Keep that in mind as we move into the actual transactions later on in the broadcast here. But our next section that we will talk about after our polling question is going to be the lease components. But we'll go ahead and launch that second polling question first.
And if you have, looks like we're having troubles with Zoom today. So if you weren't able to answer the first question, you can write it to me in the Q&A chat, your answer. Otherwise, I'll try relaunching them at the end. But I'm pretty sure we'll be able to resolve this all and get you all your CPE credits. So don't worry too much about that. I gotta close this. Oh, there we go. That one's working now. Great. I think it's because we had such a great attendance to this webinar that the Zoom is having a hard time keeping up. Anyways, Jason, you can move on.
Awesome. Thank you, Danica. So yeah, moving into lease components here. So what we're going to talk about again is both payments associated with the lease and then some extracurricular payments and how we might have those impact our calculations moving forward. So to start, this will probably make more sense as we continue going through, but we're going to talk about one aspect of the contract. So the lessee is going to make a payment of $500,000 on October 24th, 2020. So that is going to be the execution date of the contract. The payment is going to reduce the first payment due under the lease term. So the term starting on that January 1 date, which is the contractual term, the amount we owe for rent that period will actually be reduced by this $500,000. But I think the broader scale question here is, what is this $500,000 payment made on October 24th, 2020? It is considered a lease component because it is a payment that is being made in order to lease the asset. But more specifically, we will qualify that as prepaid rent, right? So under the 840 guidance, which is when this will be recognized, we will actually debit a prepaid rent asset value on our balance sheet with the corresponding credit just being the actual cash payment. So this will rest on our balance sheet for a little while. We will talk through how that will impact both the straight line expense as well as the 842 calculations. The next piece. So we've got base rent payments, of course, $500,000. Those will commence on the contractual lease commencement date. So that January 1, 2022. As a reminder, the payment right above this does decrease the initial payment owed in January of 2022. So that's really going to be nothing owed in that month. And then your $500,000 payments will begin in February. Now, these payments will increase by 3% every 12 months. So every January 1, you will have an increase in your rent payments. Really more so, it's not reflective of a CPI adjustment, but you can kind of think of this as an adjustment for inflation, just general inflation, right? We're just going to have an escalation in our rent, 3% every 12 months. the rent's going to be due on the first day of each month. So this one is the most obvious, but of course, a lease component in a contract, meaning that we are exchanging consideration for the right to use this asset. And that's what we're doing with our base rent here. So yes, of course, these base rent payments will be considered a lease component. They are lease payments, and we will capitalize these at present value when we reach the 842 transition. The next piece. So this is where this gets a little more complex. So we've got an additional component here. So the tenant has the right to use any 120 parking spaces in the parking garage that will also be constructed. The total number of parking spaces in the garage is 240. So really what we're trying to do here is identify whether the parking spaces themselves actually qualify as a lease component or a leased asset in the contract. And when we evaluate for whether an asset does qualify as a leased asset or not, we really need to think about two specific things. One, is there an identified asset explicitly or implicitly in the contract? And then the second piece is, if there is an identified asset, does the organization have the ability to obtain substantially all of the economic benefits? So we'll start with the first piece. So we can look at this one of two ways: each individual space itself or the parking garage as a whole. So what we've granted is the tenant the right to use any of the 120 spaces in the garage, total number being 240. So because there are not specific parking spaces that are provided to the tenant, and because the tenant doesn't have access to the entire garage, the tenant does not actually have an explicit or implicitly identified asset that they have the ability to control. This is more a service that's being provided to just say, hey, you can also park your car in here, but there is no specific space that they can control. The second piece of this, though, too, is to say, hey, well, if we think of the garage itself as the asset, does the tenant have the ability to control substantially all of that garage? Well, because they only have access to 50% of the space, and it's not an exact science, but most would argue that substantially all of the economic benefit would constitute normally around 90%. Because the tenant does not have access to park in 90% of the spaces, they also do not necessarily control substantially all of the parking garage. So all of that to be said, any amount of money that is related to the parking spaces themselves is not related to the lease itself. You would simply be recognizing an expense associated with the service, the ability to actually park your car. So we are going to ignore parking as any component from an 842 accounting perspective. This is not going to be a component from a leasing perspective. Part two, and we're going to have a third part as well here. So we're going to go through three more on this slide, and then I believe two on the next. So the next piece here is we're going to start getting into some additional types of payments. So the tenant is going to pay its proportional share of security, janitorial, and landscaping services to the landlord. Those types of payments are often called CAM payments, or common area maintenance costs. The amount is going to vary every year, just simply depending on the actual costs incurred by the landlord. So what are we talking about here? CAM costs. So oftentimes CAM is going to be referred to as what is considered a non-lease component. And it is a little bit of a misnomer because it is technically a component of our lease contract, but it is called a non-lease component for the purposes of you're not actually paying for the right to use an asset here, right? What you're paying for is a service that you would not otherwise pay for if you were not actually using the asset itself. And this does differentiate from the parking, because a parking space can be used regardless of whether you are actually leasing space as a tenant in a building, right? Like you as an individual can just simply park your car there. But in this scenario, you would not be paying for common area maintenance costs if you were not actually a lessee in this building. And because of that, this is going to be considered a non-lease component. But we do also want to make sure we're clear that this is a variable non-lease component. A little bit later, we will talk through one of the practical expedients that the FASB offers lessees as you transition to 842 to make it a little bit easier to manage the accounting requirements for these non-lease components in tandem with the lease components. Because this is variable, we will simply expense the amounts of these variable costs in the period that they're incurred. And we'll talk through that a little bit later. But the key thing here is to remember, this is a component. It's just a non-lease component, and it is going to be a variable expense. Now we'll get into tenant improvements. So $9.8 million here. The tenant is going to pay $9.8 million for tenant improvements owned by the tenant. So it's key to know that the tenant will actually own these improvements. So what are these? Because leasehold improvements themselves often become a little bit confusing just because the terminology states that it is a leasehold improvement. However, this is not actually going to be reflected in our lease calculations under 842. And the reason for that is because this is just simply an owned asset by the tenant. The tenant is going to capitalize this amount on their balance sheet as a leasehold improvement, and that asset will be depreciated. Now, the depreciation itself can be depreciated based on the lower of the useful life of that asset or the term of the lease if you do expect to simply stop using the asset at the end of the lease term. However, again, this is not going to be reflected in our lease payment capitalization. This is simply a fixed asset that we own. But there's more to it though. And this is where tenant improvement allowance comes into play. So the landlord as an allowance is going to reimburse us $2.3 million of that 9.8 related to the tenant improvements owned by the tenant. So in reality, this is a $2.3 million incentive, right? Because we can increase the value of our asset by $2.3 million without having to incur the cost associated with it. So the lessor is going to pay us that $2.3 million on the day that we actually access the buildings, that November 1 of 2021 date. So that $2.3 million itself, that is the allowance received from the landlord. So this is going to be considered a leasehold incentive. Now, how does the incentive actually impact our calculations from a leasing perspective? So this will both, when we transition to 842, reduce the initial value of our asset as well as reduce the straight line expense associated with the asset itself. So how to think about this qualitatively, we reduce the asset value because ultimately what we have initially paid for the asset is really an overvaluing of what it's worth because we are receiving an incentive from the landlord to enter into the contract. So ultimately we want to reduce the value of what we recognize in our balance sheet if what we paid is actually in excess of the value. And then the periodic straight line expense, of course, we also want to reduce the amount of expense that we're going to recognize throughout the term of the lease if we are actually receiving money from the landlord to pay our rent. So that's a big piece of this. Remember, it's really just the reimbursement of that tenant improvement that is going to actually impact the lease accounting as we move forward. And so two more items. So this is security deposit. So on that execution date, the tenant is going to make an additional payment of $2.5 million directly to the landlord. It's going to be a security deposit. Now, the key note here is that the security deposit will be returned upon the termination of the lease. So what does that mean? Well, if we know, all things considered, that the deposit will be returned immediately when the lease is terminated, we're not going to reflect this in our lease calculations because it technically isn't a lease payment, right? It's more so just a receivable deposit. So in that case, the tenant is really just going to recognize this as a receivable on their balance sheet, and that's going to be that. So this won't impact us moving forward. That's one consideration to make, though, as you're evaluating the contract, is to determine, is this security deposit returnable to me? Are we reasonably certain that we will receive the security deposit back? Now, our last piece, the lessor is going to require insurance payments on a biannual basis. So the cost of the insurance for the lessee is fixed in nature, as the lessor will bill the lessee $15,000 every 6 months. So when we think about the different kinds of components, right? We talked about lease components, us paying to use an asset. We talked about a non-lease component, which is us paying for a service related to the asset we're leasing. Now there's a third piece here, which is called a non-component. So this non-component that we have here is as such because the lessee is actually paying the lessor for a service that the lessee doesn't benefit from. It's the lessor that's benefiting from this. Essentially, the lessor is just requiring the lessee to reimburse them for their costs of ownership, which is the property insurance. Now, because the amount here is going to be fixed in nature, whereas the lessee is just, or the lessor is just saying, hey, we're going to bill you $15,000 no matter what every 6 months. When we talk about electing the practical expedient to combine all of those payments within the contract and just determine whether they're fixed or variable, that's when this becomes nearly indistinguishable from a lease payment, right? Because ultimately the landlord could just aggregate this $15,000 with your base rent. And if they don't itemize the contract, how would you know whether you're paying them for partial insurance reimbursement or base rent, right? So to make this easier, what we will do is consider this a fixed non-component. And again, we will talk when we get into the calculations about how this will actually impact our present value calculations moving forward. And so the next piece of this is us going to talk about borrowing rates. So how do we identify what discount rate to actually use when we adopt 842? But there's a little bit more to this as well. You'll see a few lines within this table that we've put together. So we're really trying to identify two things. So one, when do we actually determine what our rate is, and what rate do we actually use? Now, we'll complicate this a little bit here, but I promise that we will circle back to what rate we're going to use in the example. But if you recall, our lease does technically begin under the 840 guidance, right? Our initial start date is going to be that November 1, 2021 date. So what we have here is a question for you. What rate would we use under both 840 and 842? Now, an astute observer would say, well, why does it matter what rate we would use under 840 if we are not capitalizing an operating lease liability on your balance sheet? Now, that's a great question. However, when you perform the capital versus operating lease test, you would need to identify a discount rate in order to present value your minimum lease payments and compare them to 90% of the fair value of the asset. So that's a piece of the classification test. So how do we determine what rate we would use in that regard? So oddly enough, under the 840 guidance, when you look at the capital versus operating test requirements, that test is designed to be performed when you actually execute the contract. So we're going to consider that on this slide to be the inception date. So you'll see that's why we have that column there on the left. Now, what is the rate you would use? So the incremental borrowing rate under the 840 guidance does have a different definition than under the 842 guidance. So under 840, it's more so thinking about actually purchasing an asset. So what rate would a financial institution charge you to actually purchase outright the asset under lease? So because of that, you're going to identify potentially a unique rate as it compares to the requirements under 842. So what we've done again here is identified under 840, the initial rate that we would use in this scenario to classify the lease appropriately is going to be that 8.75% at the top left of our table. So that's what we would use on October 24th, 2020 to determine whether this lease qualifies as an operating lease or a capital lease. And we're just going to consider it an operating lease just for the sake of the presentation here. So we can even avoid having to perform that calculation. Now, the second piece of this course is what rate would we use under 842? So under 842, do we just use that 8.75% when we get to the transition date? What do we do here? So what the standard would suggest in the basis of conclusions is that in order to have the most relevant financial information capitalized on your balance sheet, for any lease that begins prior to the transition to 842, you would want to utilize the rate applicable within the transition period in order to capitalize that amount on your balance sheet at the correct value. So for 842, what we want to do is utilize the rate that is applicable from a transition standpoint, the later of the commencement date or the transition date. Now, because our lease commencement date, that November 2021 date, occurs prior to our transition date, we're going to use the later of, which is the transition date. So we're going to use the rate that's in the far right side of the column. Now, what rate is it? Well, there's of course two more rows here. And as I mentioned, the definition of the IBR changes under 842. So the thing that changes is rather than focusing on purchasing the asset, the definition changes to more appropriately meet the nature of the transaction, which is a lease itself. So whatever rate a financial institution would charge you in order to pay off the annuity or to obtain a collateralized loan to pay off the annuity that you owe for the lease itself. So it's a little bit different of a definition, but that's what that middle line is, the IBR for secured borrowing. So that's 7.2%. That is the rate that we're going to use in our example in just a couple slides. So the 7.2%, again, it's observed on the transition date because that is the later of the transition date and the date that the lease actually begins. So that's what we're going to use to capitalize our lease payments. Now, you'll notice that there's a risk-free rate line at the bottom. So we point out, in addition to the incremental borrowing rate, private companies do also have the ability to utilize a risk-free treasury rate to make the process a little bit easier for adopting the new standard. Now, previously, that rate was allowed to be selected at the entire portfolio level and nothing else. You would either have to use it for all of your leases or none of them. Now the boards have actually changed their mind and they're going to allow you to elect this rate on an asset class basis. So you can determine certain types of assets that you'll use a risk-free rate for. In others, you can use the incremental borrowing rate for. Now, a couple caveats to think about with the risk-free rate. One of them is if you do use the rate, your present value calculations will, of course, be higher because the lower the rate, the lower that you're actually present valuing, which means the higher the total dollar amount on your balance sheet. So if those might impact certain financial ratios, you may want to consider the impact before making that decision. The second piece, if you are a private company that does have plans to eventually go public or could potentially be acquired by a public company, you would unfortunately have to restate your financial statements retrospectively to utilize an incremental borrowing rate in that scenario, which of course would be done during a due diligence session. So we would advise just generically, if either of those are considerations for you, you might want to avoid the risk-free rate, but it is an option for small private companies that of course have no plans to ever move in the public direction. So that's really the gist of the borrowing rate. I think it's worth pointing out as well, For those of you wondering, of course, the standard does initially suggest that a lessee should use the rate that is implicit within the contract. However, in practice, we often see that the lessee does not have all of the necessary information to calculate what that incremental or what that implicit rate might be. So we often just jump to talking about the incremental borrowing rate, as that is very more commonly used than the implicit rate. But yes, the implicit rate would be suggested if you have all of the information necessary to calculate that rate. And if you were curious, Lease Query does have a free tool on our website that does offer you the ability to throw in the inputs and actually calculate your implicit rate. So if that was something you wanted to test out, you can find that on our website. But yeah, so that'll cover us from a borrowing rate perspective. And we can take a quick pause here for our third polling question, and then we will get into the actual transactions to wrap up the presentation.
Looks like that one worked. Fantastic. And for those of you that weren't able to answer the first or second polling question, I will relaunch them towards the end of the presentation. So no worries. And I promise I will get everyone their CPE as long as you have showed you're engaged in terms of being on the computer and audio. Thanks, Jason. You can continue.
Awesome. Thank you. All right. Whew. So initial journal entries. So we've made it all the way to the actual calculation piece of this. And so again, if you would like, please feel free to reach out via email if you have questions on any of these calculations that we have performed here. But what we are doing initially is trying to identify what our lease liability balance is. So just as a reminder on some of the inputs here. So we have base rent at $500,000. That begins in January of 2022, but as a reminder, that first month is reduced. So the payments are really beginning in February of 2022. They increase by 3% every January 1. Payments are due at the beginning of the month. We are also, due to the practical expedient, going to include those fixed insurance payments of $15,000. Those will be payable every 6 months. So June 1 and December 1 is when those $15,000 payments will be added to our base rent. Those will stay the same every year. We're going to use that borrowing rate of 7.2%. So both the insurance and the base rent are going to end up being capitalized on the balance sheet together as a lease liability. And when you do all of that and wave the magic wand, the value of our opening lease liability at January 1, 2022 is going to be that $44,100,433. And I know we've jumped a few steps here. Where's the value as of November of 2021? Remember, what we've done here is actually calculated the opening liability value as of our transition to 842. We will walk through in a couple slides what we need to do under the 840 standard prior to actually reaching this adoption date. But in order to just initially calculate that liability, we want to make sure we have our payments scheduled, both the fixed insurance payments and the base rent. We've got our borrowing rate correct, and that's how we capitalized that $44 million. Now, the next piece is identifying what our ROU asset is. And that's where this gets a little bit complicated because of the fact that this lease begins under the 840 guidance. So we'll start with the lease liability. So that's where you'll always begin when identifying the ROU asset. And for any new lease that begins after transition and does not have any incentive paid before the commencement date, you may just have a ROU asset that equals the lease liability. But in this scenario here, cumulative deferred rent, we are going to actually adjust the lease liability 2 different times. First being the amount of deferred rent that we have on our balance sheet at transition. So as a reminder, deferred rent under the 842 standard or under the 840 standard is just simply capturing the variance between the cash flow and the accrual you make to recognize expense straight line over the term. So what we have done here is put together an 840 schedule to showcase to you what we have to do during that 840 period. So when the lease begins in November 2021, remember, we already have a $500,000 prepaid rent balance on the balance sheet. That's the $500K that we paid on the execution date of the contract. That was the very first line we talked through in our lease component slide. Now, each period, November 21 and December 21, we're not actually making payment on the lease, right? Because the payments aren't going to begin until 2022. But we do, from an accrual standpoint, have to recognize straight line expense. We will walk through towards the end here how we actually derived at that straight line expense amount, but that $535,679 is the amount we're recognizing for expense. So that is deferred rent in November, December 2021. And you'll see that within the deferred or prepaid rent column. We also have to accumulate this and net this against the initial prepaid rent that we recognize. So once you do all the netting on the far right side, that's when you get, as of the day we transition to 842, a cumulative deferred rent amount of $571,358. And just so everyone is familiar with the term deferred rent, I think sometimes thinking about it qualitatively actually helps understand the math behind this. But what are we really talking about here? Deferred rent is when you recognize an expense, an amount, but have not yet actually paid in relation to that expense. So we are deferring payment until later into the term, but we've already used the asset. So qualitatively, if we've already used the asset for that period, we don't want to then double the expense by recognizing that portion of the asset when we capitalize this amount on our balance sheet. So because of that, we're going to take that opening asset value and reduce it by the amount that we have already determined has been expensed, but just hasn't been paid for yet. Now, there's more to this too, and it's a very similar concept. So we're going to also reduce the liability by the remaining incentive liability balance here. And so what is the incentive liability? As a reminder, that $2.3 million that the landlord reimbursed the tenant for, when that reimbursement took place in November of 2021, the lessee is actually recognizing on their balance sheet a credit and in $2.3 million for a lease incentive liability. The debit, of course, would be the cash itself. Now, what do you do with that incentive? Well, over the term of the lease, you are going to reduce the amount recognized for expense straight line over the term. So that $20,909 is essentially taking the $2.3 million balance and dividing it evenly over the full 110-month period. So that is the amount we are actually reducing our straight line expense by. But then the question begs, well, why are we reducing our asset by this when we get to the transition? So of course, when we get to the transition, our straight line expense calculation is actually going to, of course, remain the same, right? Now, what we need to do to make sure that our expense is appropriate is, because we know that this incentive in total will reduce the expense we recognize by 2.3 million. And we also know that our entire asset balance will be expensed from its opening value to zero. In order to ensure we do not duplicate that expense, we need to reduce the amount we recognize in the ROU asset by the amount that we have not yet reduced our expense by. So again, in this example, we have reduced our expense by $41,800-ish. And once we've done that, we still have $2.249 million left to reduce our expense by. So rather than doing it all at once, we simply reduce our asset value by it. And then in nature, that will also evenly reduce the expense over the term. So that will lead us to what our opening ROU asset value is going to be on the screen right here down at the bottom. So we have reduced our asset calculation here from the 44.1 of the opening lease liability to $41,279,893. And so after we do that, the opening journal entry that you see is actually going to effectively mirror these mathematics that you see on the screen right here in front of you. But nevertheless, we will ask, what are the initial journal entries that you would recognize at the transition here? And so that's going to be a debit, of course, to the ROU asset for the 41 million that we just talked about, the lease liability credit at the bottom for the 44 million. And then in addition to that, you will also see the removal on the balance sheet of that deferred rent, as well as the lease incentive liability. Now, both of those balances are reflected as a reduction to the ROU asset. So if you broke it out in gross, you could see both debits and credits to the ROU asset, but this journal entry is netted, right? So that 41 million is net of the deferred rent and the lease incentive liability. And so our last piece here, what are going to be the subsequent journal entries that we recognize after transition? Now, as promised, we wanted to walk through how we actually derived at our straight line expense calculation here. So we started with the prepayment in October of 2020. That's going to be $500,000. Now, the reason we are including that again is because that is a payment we are making to use the asset. So it does need to be reflected at some point in expense. We just wait to expense it until we actually reach the period of using the asset. Now, in addition to that, as a reminder, we want to reduce this amount by the tenant improvement allowance reimbursement. When we initially calculate our straight line expense, if we did not include this amount in our calculation, we would have to take the straight line expense calculation and every period reduce it by the 2.3 million divided by 110. But if you want to just simply identify what the actual net straight line expense will be, you can reduce it up front here, right? So we'll take that and reduce our total payments. Now, both gross base rent and gross insurance payments are included here as well. So we have the 60,454,000, the 270,000 gross insurance payments owed. That will get us to a total amount to expense of 58,924,637. So that is the adding and netting of all of those lease payments right there. So that is the amount we will divide by the number of periods that we have within the term, which is going to be 110 total periods. And that is going to give us the straight line expense that we will recognize of 535,679. So that is the amount you will see as the expense within the journal entry. So that's how we derived at the straight line expense that we'll recognize every period. And so what is that journal entry going to look like? And we will mirror this with the amortization schedule on our final slide. And this is going to be for February, right? We wanted to showcase a period in which we actually made a lease payment. So that 535,679, we show it as an expense at the top. We also wanted to point out the CAM expense. Remember, the variable expense is going to be booked in the period in which the cost is incurred. And we're just going to pretend that there was a maintenance charge for $10,000 that was billed to the lessee during the period. So you can see the CAM expense, if it's variable, will be recognized separately from the operating lease expense. Now, we're also going to credit cash, which is going to consist of the $500,000 rent payment and the $10,000 payment for CAM. So that's why we have $510,000. Now, the liability reduction of 233, as well as the asset reduction of 269, both of those are a little complicated in terms of where we get to those numbers. So that's why we have included on the subsequent slide here a copy of the initial couple periods of the amortization schedule. So highlighted in orange will be the row that we will look at. But starting with the reduction value in our liability, you can see the third column of numbers will have the liability reduction amount of 233,810. So what we are doing there is we are simply taking the difference between that gross cash payment of $500,000 that we recognize, and then we are reducing that by the amount of the liability lease expense. Now, what is liability lease expense? that is actually the same calculation as an interest expense calculation for a capital lease. Now, it's hard to verbally explain some of this, which again is why organizations often look to technology to do this work for them. But ultimately, you would be calculating based on the prior period balance of the liability, also based on what your discount rate is, what that interest amount is for the period. So if we calculate that 266,190, we just simply take the difference. That is the amount that we are reducing our present value principal amount by. So that's where we get the debit and the liability of 233,810. Now, the asset reduction, how do we derive at that? That's going to be a plug actually, and we can explain. On the far right side, we already know that we are going to expense 535,679 every single period, no matter what. That's going to be our straight line operating lease expense. That does not change under the 842 guidance. You will now just simply have the asset liability. Now, the asset expense itself, what you will do to record the appropriate asset value is you will simply take the variance between the total amount you recognize an expense on the far right, which is going to be the 535, and just simply reduce that by the liability lease expense calculation. So if we took the 535, reduced it by the 266, that is where we have derived the 269,489 value in the asset lease expense column. So ultimately, the amount you amortize the asset by over the term is a plug, just the difference between what you calculate as interest, which of course is the variance between the present value and the gross calculation. And then the asset value is just a plug to represent what you would get to between the total gross cash evenly recognized over the period and the present value amount of the asset. So again, a lot of words there, but ultimately that's where those numbers are coming from. Again, the fact that the asset isn't straight lined is another reason why organizations say, hey, we're just going to rely on technology to help us calculate all of these schedules for us. But with that, that's going to be it for us. We do have a final polling question here. We do offer, of course, demonstrations of our product complimentary. So if you would like to see a demonstration of the Lease Query product, we are more than happy to provide that for you. And you would have access to one of our technical accounting consultants who can walk you through the system and answer any questions you might have on the 842 compliance piece. But just to summarize real quick what we've done today, we've obviously talked through the importance of all key dates within a leasing contract, using those to determine the requirements to measure the appropriate term from an accounting perspective. We've also identified correct borrowing rates based on when the lease begins and whether the lease begins under 840 or 842 guidance. And then lastly, of course, we've showcased how to calculate and post initial and subsequent journal entries under 842. So we do have linked here a few additional articles. COVID obviously is on the downswing, but we do have some articles related to accounting for, say, concessions provided for COVID-19, impairments, et cetera. If you have any questions on those, these are all articles that are attached to the presentation. But with that, I think, Danica, I'll pass it over to you to wrap us up.
Yes, so don't forget your account managers for Stage 100, Lizzie Palladino on the West Coast, Michelle Lodano on the East Coast, Mike Scher for X3 and 500 on the West Coast, Gia Lane for X3 and 500 on the East Coast, and then Lisa Gillette for Sage Intact. Again, remember to look for an email from Prolera regarding the CPE. If you do not get it, please check your junk, check with your IT. Otherwise, contact me and we will get this figured out for you. Thank you guys so much. It was a very informal webinar. Thanks, Jason and Lease Query.
Of course. Thanks everyone for joining us today.
Oh, hold on. There's some questions. Oh, whoa. Those came in during the presentation.
Awesome. Yeah, well, we have
They're asking about the
like
different percentage rates. Where do they come in from? The 8.75, the 7.2.
The rates were totally manufactured by me. They did not come from literally anywhere. I just made them up. So.
And then will you cover, were there examples of the sublease portion or space to a subtenant?
Yeah, not of course in this presentation as it is over now, but we do have articles that talk through subleases, of course, and how the accounting for a sublease would coincide with the accounting for the head lease itself. And so, yeah, if you do have questions, we can certainly point you in the right direction there.
And then do you see the amortization expense for the LHI credit difference in November and December?
Yeah. Well, yeah, I think there was a typo there. We'll fix that.
Then a couple of you are saying you did not get to answer the polling questions, which I'm super confused about since I relaunched them. I will relaunch number 2. For those of you who still needed to answer it. And then after that, I can relaunch number 3. But if you feel you answered it and you didn't get an error, then no worries. Zoom just was not made for this volume of attendees, I feel. Okay, I will close question 2. I had already reopened question 1, and then I will relaunch question 3. Closing now for question 2. And here I'm relaunching 3 for those of you who thought you did not get to answer that. I'm so sorry about this. I'm not sure what happened to Zoom. I even closed down all the applications on my computer. Oh, Jason, was there any, it looks like maybe there was any more questions? There was 60 attendees today. And you got some. Thank you very much, Jason. This was very informative and helpful.
Awesome.
So I will end that poll. And thank you guys, and have a great day.